Trust but verify. It's a phrase that was popularized by Ronald Reagan, and in fact some people think that he's the one who coined the phrase. But the reality is, during the mid to late 80s, when the United States and Russia and the Russia were in nuclear disarmament agreements, Reagan was advised that Russians like to speak in proverbs. So he took a Russian proverb, which I'm not going to butcher now because I don't speak Russian, that was trust but verify, to use it on Gorbachev. And it became a very popular phrase. And it's very apropos now. Trust but verify. That's something that we've lived by here at Kruse Asset Management, because while we hear the rules and axioms of Wall Street all the time, we like to verify them. One of those rules is don't fight the Fed. For a long time, years and years and years, the Fed has been extremely accommodative, lowering interest rates. And what that suggests is as the Fed lowers interest rates, that props up the stock market. And if the Fed starts raising interest rates, well, the stock market will have headwinds. So you should be very aggressive when the Fed is dropping rates and a little bit more cautious when the Fed is raising rates. But really, we should see if that's true. Let's trust and verify. My name is Stuart Kruse. I run Kruse Asset Management. We're a boutique asset management firm founded on the principles of using math and statistics to guide our investment decisions. So what we're going to do right now is go over to my computer and look at some of the data and trust but verify whether we should or should not fight the Fed. Because right now, the Fed has a Fed meeting coming up and they're looking to reverse their tactic. So whether you think they're going to raise or lower interest rates, and whether this is now or a year from now in the future, this is good data and good information to have. So let's cut away, go over to my computer, and let's see whether we should fight the Fed or not. Hey, thanks for joining me and for trying to test out the axiom, don't fight the Fed. Because here at Kruse Asset Management, we like to trust but verify. We use data to help make our investment decisions. So what should we do? Should we fight the Fed or not? Well, in recent history, the Fed has been very accommodative, keeping interest rates basically at zero for years. And then more recently, they started raising interest rates as the economy is improving. But the president has been calling for a big rate cut because he feels like the economy, or at least the stock market, is not moving as high as it should be. I mean, we are close to all-time highs and unemployment is extremely low. The economy is doing really relatively pretty good. But what he wants is a better, more robust stock market. So the question is, do we need to cut rates? And should we cut rates? And if he does cut rates, or Federal Chairman Powell cuts rates, what does that mean for the stock market? So let's take a look at the data, because that's what we like to do. We get our data from our friends over at YCharts. That's ycharts.com. They provide all sorts of analytics, and it's a phenomenal website. So if you get a chance, go check those guys out. So here we have the target federal funds rate, lower limit, as downloaded by YCharts, and we're looking at over 15 years of data. I'm sorry. We're looking at, here we are, going back to 1994, so 25 years of data we have. The S&P 500, and then whether we're in a rising or declining interest rate environment. So right now, interest rates have been moving higher since 2015, when the Fed first moved 25 basis points in 2015, and since then we've been in a higher interest rate environment. Prior to that, you can see a long string of lower, where we were dropping rates since 2007, before the financial meltdown. But the question is, what's better for the stock market? Higher rates or lower rates? And which environment? So just doing some quick math down here, we look at the 3-month average rate straight up with no not taking into consideration rising interest rate environments or declining. The average 3-month return is a little over 2% during those 25 years, 4.2% in those 6 months, and then in any 1 year, we're looking at about an 8.5% return. But if we just limit those terms to a rising interest rate environment, what we see here is we outperform by about 20% across the board In the 3-month period in a rising interest rate environment, we get almost 2.5% return a month in that time period, 5.2% in 6 months, and over 10% in any 12-month period. So that's pretty robust. So if we're above average on the rise, then we must be below average when the lowering environment is, and that's exactly what we see. So in a declining interest rate environment, we see federal funds rate or the stock market returning less than 2%, 1.7 in a 3-month, or you can read the numbers, 3.5 in 6 months, and 7.3, which is pretty paltry in any 12-month period. Underperforming by about, 14 to 16% across the board in a lowering interest rate environment. All right, but let's dive into the numbers a little bit more and see if we can discern something. So let's look at the higher interest rate environment. And let's do a scatter plot, which is what we have right here, a scatter plot. So what this chart says is, of all the times that we have been in a rising interest rate environment, what have the 12-month returns been like? And so here we see that just about all the time, here's the interest rates. So just about all the time, as long as we're under 5%, and we're well under 5% now, we're at 2.25%, as long as we're under 5% in a rising interest rate environment, that suggests that the economy is pretty strong. And we have, except for 1, maybe 2 times, have had very, very few instances of a negative stock return in a rising interest rate environment. So it looks pretty solid. And that's what we're in right now. We're in a rising interest rate environment, and over 12 months, we've never seen a negative stock return, except for this one time back here, which happened, looks like, I guess I give it, so it did happen one time. But we have quite a few data points where that's not the case. Now, if we're above 5.25%, that changes things quite a bit. Rising interest rate environment might be a tax on the economy, might signal inflation, might signal a lot of other headwinds that we have in place. And we've had quite a few negative returns when the federal funds rate was above 5.25%. Of course, we've also had some positive returns, but there's a lot more negative down here than there are on this side. So anything over 5.25%, probably don't want rising interest rate. Anything under 5.25%, if we're in a rising interest rate environment, that signals a strong economy. What about on the other side, on the low side? In a declining interest rate economy, this is a scatter chart, scatter plot. Now over here is a plot of all the times that we were in a zero interest rate environment and how the market did. And it actually did pretty reasonably well. We definitely had some periods where we underperformed and had some negative returns, but on average, we had some pretty great returns over the years in this zero interest rate environment. Looks pretty solid. And these are rolling 12-month periods. Okay? We see some pretty good numbers, but when we get past this 1.75% in a declining interest rate environment, past this 1.75%, this is when we start seeing negative numbers. This is what brings the average down. We're at 2.25%. So if we drop down to 2% or 1.75%, that would suggest pretty heavily that we are going to have some headwinds ahead of us, and that we should probably reduce our exposure to the stock market, at least for the next 12 months. And maybe until the market dropped into the interest rates dropped into the 1.5 to 1.25 zone, because that's when you started getting positive returns again. But where we're at right now suggests that we will be in negative returns. Anything, again, below that 5% number looks like we're going to be in negative returns. So if Chairman Powell drops interest rates tomorrow, we might really want to consider reducing our equity exposure, if you have equity at all. Right now, technically, it looks long-term weak, even though we've had a nice month so far in June. May was pretty bad. And this technical weakness really started setting up back in October and really consolidated itself and gave us a follow-through signal in December. So all the while we had a great rebound, we're still not back to our higher highs and are forming slightly lower highs. So technically we look a little bit weak long-term, and then a drop in interest rates by Federal Powell might suggest that we're going to be in for a little rough waters ahead for the next 12 months. So let's wait and see. But this data is good regardless of whether we are talking about now in today's environment or a year from now, we can come back to this data and say, what does it look like? Are we in a low interest rate environment going higher, or are we in a high interest rate environment going lower? We can come back and check out to see where we might make our moves within the stock market according to the data, not according to my hunches or feels or anything else. So thanks so much for watching, and if you like more of this information, check out some of our other videos. Like us on Facebook, and you can see us on LinkedIn, and I look forward to seeing you in our next analysis. Thanks. This is Stuart Kruse from Kruse Asset Management, signing off. Take care.